Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial secrets of the corporate world. And let's just say this next report from the Federal Home Loan Bank of Cincinnati might have a few hidden numbers to reveal like a magic trick. But for your finances, don't be scared, though we will make it simple and clear. This filing is all about new funding deals, and in the world of finance, that means a lot of money is changing hands and moving around like a global game of musical chairs. And we are going to look at where that money is going and who is getting it. At I've said, though we will make it simple and clear. I'll few hidden numbers to reveal like a magic trick, but for your finances, don't be scared, though we will make it simple and clear acclimates. If you want to join a community of fellow corporate explorers, link to our Discord is in the description below. So what we have here is a report that tells us about new borrowing. Essentially, the Federal Home Loan Bank of Cincinnati is issuing new debt to keep its operations running and to provide funds to its members, which are often other financial institutions like banks and credit unions. Think of it as a giant loan marketplace. This bank is one of 11 federal home loan banks across the country, and they are all part of a system designed to support housing finance and community development in the United States. Now, this part is just routine compliance stuff telling us what other rules this report might be following, but it is not the main story for us today. This is where the action is. It is telling us about new financial commitments for the bank, specifically the creation of what they call consolidated obligations. These are basically bonds issued by the federal home loan banks to raise money. This is pretty important to understand. These bonds are backed by the financial health of the 11 federal home loan banks themselves, not directly by the US government. That means while they are considered very safe investments because of the system structure, it is not a direct government guarantee like some other financial products. Alright, now we get to the juicy part, the actual deals, the bonds being issued. This schedule is like a catalogue of new loans, if you will. It lists when these bonds are issued, how long they will be outstanding, and what they pay in interest. Okay, so looking at the table here, we see multiple bond issuances all happening around early July of 2025. Let's take the first one with this obscure code called a CQZIP number, which is like a fingerprint for a security. This bond was issued on July 10th and it will finally be paid back on July 17th, 2040. That is a very long time, a full 15 years. This is what we call a long-term debt, and for this 15-year loan, the bank is paying an interest rate of 5.8%. This is a fixed rate, meaning it stays the same for the entire 15 years, so the bank knows exactly how much it has to pay each time. And the amount borrowed for this specific bond is $16 million. This is a significant amount, but it is just one piece of a much larger picture for the bank. Now let's look at the next bond also issued on July 10th. This one has a slightly shorter maturity date. It matures on July 16th, 2035, so it is a 10-year bond. The interest rate here is 5.375%, which is a bit lower than the previous one. This difference in rates often reflects market conditions and how long the money is borrowed for, and the amount borrowed in this case is $17 million, a little bit more than the first one. Here's another one from the same day, July 10th. This one has a much shorter term maturing on July 23rd, 2029, which makes it a little over 4 years long. The interest rate is 4.08%, which is considerably lower than the longer term bonds. This flexibility in borrowing for different durations is key to managing the bank's overall debt costs. This issuance is for $10 million. Another deal on the 10th of July. This bond matures on July 28th, 2022, so it is a 7-year loan. The interest rate is 5.18%, and the amount is $20 million, pretty substantial. We have one more from the July 10th batch. This bond matures on July 25th, 2030, making it a 5-year commitment. The interest rate is 4.05%, again a lower rate, reflecting the shorter term. This issuance is for $20 million. Now, shifting to July 11th, we see a different kind of issuance. This is a shorter term note maturing on March 12th, 2026, so it is less than a year. Note the difference in the call type here. It is listed as non-ECI, which means the bank cannot pay it back early. And it also says variable single index floater, which means the interest rate can change based on some market index. And the amount here is absolutely massive, $750 million. This is a much larger chunk of money than the previous fixed rate bonds. And another one on July 11th. This one matures on March 16th, 2026, also short-term and non-callable. Again, it is a variable rate tied to an index, and this issuance is for an enormous $782 million. These descriptions help us understand how these bonds work. For example, optional principal redemption bonds or callable bonds can be paid back by the bank early if it is beneficial for them. Think of it like refinancing your mortgage. If interest rates drop, you might want to pay off the old loan and get a new one at a lower rate. This tells us how and when the bank can choose to pay back the bonds. American bonds, for example, can be redeemed anytime from a specific date until maturity, while European bonds can only be redeemed on one specific date, if at all. This simply distinguishes between fixed rate bonds where the interest rate stays the same throughout its life and variable rate bonds where the interest rate can change. This digs deeper into variable rates, explaining if they are tied to a single index, perhaps LIBOR or SOR, fluctuating up and down, or if they are more complex like range bonds that pay different rates depending on whether an index is within a certain band. This really helps understand the risk and potential reward for the investor and the borrower. And finally, the report is signed off by Alison D. Kieft, who holds the title of First Vice President Assistant Controller, indicating the seriousness and official nature of this filing. Now for my take on this Federal Home Loan Bank of Cincinnati filing while the bank is issuing a lot of debt here. We see a mix of long-term fixed-rate bonds, which lock in borrowing costs, and shorter-term variable-rate bonds, which could be more susceptible to interest rate fluctuations. The really large variable-rate issuances on July 11th stand out, due to their size and the fact that their interest payments will change. This suggests the bank is actively managing its funding costs and strategy, often in anticipation of or reaction to broader economic conditions and interest rate movements. The bank's overall approach seems to be about securing diverse funding sources to meet the needs of its member institutions, or reaction to broader economic conditions and interest rate movements. The bank's overall approach seems to be about securing diverse funding sources to meet the needs of its member institutions, or reaction to broader economic conditions and interest rate movements. The bank's overall approach seems to be about securing diverse funding sources. A key takeaway is how the bank mixes short-term and long-term borrowing. This kind of strategy can help balance funding costs and interest rate risk. For example, if they expect rates to fall in the future, they might issue more short-term debt so they can refinance at lower rates sooner rather than being locked into higher rates for a long time. The risks here are tied to interest rate changes. These variable rate bonds could become more expensive if interest rates climb significantly. Also, the fact that these are not government guaranteed means investors are relying on the bank's own financial strength, which historically has been very stable for these institutions. However, any systemic risk to the financial system could indirectly impact their RAS. Overall, the Federal Home Loan Bank of Cincinnati is executing its role of providing liquidity to the financial system by issuing debt, a critical function for economic stability. What's your opinion on these debt issuances? Are they a sign of strength or a potential worry? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more in-depth financial analysis. Don't forget to join our Discord community linked in the description to continue the conversation. Thanks for watching. See you next time.